After about 4 decades of relatively low inflation, consumer prices are skyrocketing again. In an effort to curb inflation, the Federal Reserve has been signaling that it plans to raise interest rates. In fact, the Fed could raise interest rates several times this year. So what does it mean for your money? We're joined by financial analyst Christian Clausen from Burns Financial to break it all down. Christian, good morning to you. I mean, out of the box here, how large an increase are we talking about?
Well, they were expecting they were going to do 0.5%, but I think because of the war in Ukraine and some of the other things, like they're probably only going to be about 0.25%.
Okay, so obviously that will have an effect on the prime interest rate, mortgage rates, anything that anybody borrows money for. You're going to see that hit. How about the markets? How will it affect the markets?
We think typically the market doesn't have that big of an effect if we look, months out, a year out. In the beginning, we'll see a little bit of extra volatility, but after that, it typically settled down. The thing here now is that, over the last three times that they raised interest rates, market had been positive because of it, but it's also because the Feds have raised interest rates because they could, they felt like the economy was strong enough. Here, it's because of inflation, and it may be one of those things where they're forced to, not just because they want to.
Well, you mentioned Russia, and it seems to me that Russia is the big wild card here in the whole thing because, hopefully this somehow ends in some way in the coming weeks. But we could be looking at years of conflict. So how do you even kind of forecast what to expect?
Yeah, well, they have to focus on the U.S. economy first. The Russian war, against Ukraine, it's something that's going to slow down the way that they would increase the rates. So we were expecting them to do maybe 9 increases for this year. And now with that uncertainty, it may be, 4 or 5 instead. So we definitely have to pay attention to this.
So what does the small guy do to protect himself? Obviously, some spending habits could certainly change, but if somebody has some investments, what do you think?
Well, most of the time, what is most sensitive to interest rate hikes are fixed income and bonds. So what you want to do is you want to make sure you don't have too long maturities. Some people have, 10, 15, 20-year type of fixed instrument or fixed, bonds. You want to have more short-term. You also want to have floating rate securities, which are repriced when interest rate goes up, so they're not as sensitive. So there are ways to take advantage of it and not put yourself in harm.
Kind of and sort of review what you've got and whether it makes sense in not yesterday's reality but tomorrow's.
Oh, absolutely, absolutely.
All right, Christian Clausen, thanks so much. We appreciate your time this morning.
Thank you.